Hi guys,
Hi guys.
this is Unraveling Systems, and today we present to you our introduction video for topic number 3, commodity market derivatives and their impact on ecosystems.
So to explain you this topic, we picked a specific commodity that every student loves, especially when you prepare your exams, which is coffee. So I would say we start with some basic facts about coffee.
Most of the coffee is produced in the global south, where most of it is consumed in the global north.
The cultivation of coffee itself exercises lots of pressures on the environment in terms of biodiversity loss, water flows, carbon sequestration, nutrient cycling, waste decomposition, and soil formation.
Coffee is also the most traded agro-commodity right now, so the demand for coffee is expected to increase by 15% in the coming 5 years.
If this was not enough, the market for coffee has underwent an increasing financialization, meaning that lots of investments in coffee as an asset class have been done, and there has been an increase in trading of futures contracts, especially by large financial investors.
70% of this labor-intensive crop is grown by smallholders, meaning small farmers.
So now we're going to zoom in on the coffee production chain to explain you how these smallholders on one side and the large financial investors on the other side are interacting and what are the consequences of this. So have a look. This is the coffee supply chain. At the bottom of the chain we have the smallholders who grow coffee. Once the coffee is ready, they pick the cherries and bring them to a cooperative that in turn will bring all the coffee picked up by the different smallholders and their family to the curing plant. After this step, the coffee is brought to the trading house, where it is bought eventually by a trader. Once that the trader has acquired the green beans, those go through different steps along the chain. First, the exporters that bring them typically in the global north, then the roaster houses. Then, once the coffee has been roasted, it's sold to a retailer that then will eventually deliver it to the final consumer. Keep in mind that the price that the smallholder is receiving for his coffee is extremely low, while on the other hand, the final consumer pays a fairly high price for a cup of coffee. What determines the price at which the trader is willing to buy the coffee from the smallholder? Well, intuitively, and as we would think in theory, the supply and demand for coffee are those that determine the price of the commodity. However, the fact that coffee is a financialized commodity means that the trade in C future on the stock exchange in New York is seen as a reliable indicator of proper price for the coffee. This means that the cooperatives cannot really demand to sell their coffee at a higher price than that is dictated by the stock exchange. This would disadvantage the trader, since the following actor in the chain, which is the exporter, and then the roaster house after that, will not be willing to buy coffee at a higher price than the one given by the stock exchange.
But wait a minute, why do market actors rely so heavily on the price indication given by these future markets?
Maybe it's because futures are believed to be efficient in the sense that they should incorporate all knowable market information and therefore they should enable an efficient price allocation. And the second reason is that they allow speculation and therefore they should stimulate a better allocation of supplies over time and also reduce price volatility. So, this was the theory. But if we look at the reality, what we see is that on one hand, the C future is the most important determining factor for the price of the real coffee. And on the other hand, we can connect high levels of speculation with a higher price volatility.
Okay.
Given that these farmers are already receiving a very low price for their product, this higher volatility makes it more challenging for them to manage their living costs.
Wow. And then they also have to deal with climate change, right? So it is said that climate change right now is really reducing the suitable land for coffee cultivation. For example, in Uganda, we have seen that the drought periods have been extended over the last years, even in the rainy seasons. This hampers the flowering stage of the coffee crop, and this leads to lower yield of coffee in general. Above that, the changing weather patterns also increase the occurrence of diseases and pests.
But given this situation, what are the remaining options for the smallholders?
Well, I've heard of 3 strategies these smallholders implement. First of all, they can extend their cropland and shift to sun-grown coffee. This leads to higher yields, but also higher environmental costs. A second option is to shift to another crop with unpredictable environmental consequences. A third option is to get their coffee fair trade certified. The added benefit of this is that the fair trade organization reduces the price volatility through the implementation of a floor price. However, fair trade is still a niche market and the demand is relatively low.
So to conclude, keeping in mind the economic variable and the environmental variable, what we can say is that low and volatile prices do not guarantee long-term stability for these small farmers, and they have also limited incentives to farm sustainably or to implement adaptation strategies to climate change. Guys, keep in mind that coffee is just an example. The financialization of nature goes way beyond this market. Look at the example of ecosystem services. If you want to know more about this topic we just mentioned now, check the folder.
So guys, that was it for this introduction video on topic 3. In the next video on the same topic, we'll have a nice interview with Susan Newman. Bye!
Bye.